assume that you can hear me correctly, right?
Yes.
Hear me clearly? Okay, cool.
Yeah.
So it's my great pleasure to speak in the Warwick Stochastic Finance Seminar. It's my first time speaking at Warwick. So it's really a great opportunity for me to present this work, especially seeing that Paul Ambrecht's my longtime collaborator and basically otherwise academic, partially my academic advisor is here. So it's really a great opportunity for me to present this work. So this work may be different from your usual work in stochastic finance, because this work, there's nothing really stochastic. It's really more the one period type of characterization. But we're very happy about this work because I think it solves one of the very, very long-standing problem of characterizing the expected shortfall as a risk matter. So I will start from there. The object we work with is risk matters, as some of you probably know very, very well. I know Martin has worked on risk matter a lot. If not, risk matter would be a mapping, which maps a risk, which usually is a random variable, to a number, and that number can represent different things. It can represent, for instance, regulatory capital calculation. This is the most important interpretation used in the first paper on coherent risk matters by Freddie Delvan, David Heath, and co-authors. So this will be our main focus. The main focus would be you have a loss or profit, but usually we care more about the loss. You map that loss to a number, and that number will represent how much money you would need to set aside as capital so that you can operate on this possible random loss. So this is the basic main interpretation of a risk matter, although there are many other usage of risk matters, for instance, in insurance pricing, in optimization, portfolio selection, or in performance analysis. And all of them are quite practical because in different fields, you may need to map a loss to different numbers with different meanings. Okay, so that's the basic whole picture, and that's also why risk matters has been very popular. And there are a lot of research, a lot of papers on risk matters from different angles, in operation research, in finance, in insurance, in risk management. In our own field, there's a lot of research as well. So in this talk, I will use risk as losses, random losses, which means that if they're positive, they will mean that they incur a loss. Okay, so this is the typical interpretation from actuarial and risk management perspective. In math finance, of course, there's more common that you see the other side. You have positive number that's surplus, negative number that's in deficit. But in this talk, positive numbers are losses, and this f of x would denote the CDF of a loss. That's standard. So the two most important risk matters used in practice are expected shortfall and value risk. The value risk would be a quantile, a left quantile in particular. Of course, you can set it to be right quantile in different contexts. It doesn't really matter that much. In this talk, I will just set it to be the left quantile. So here we see that the value risk is the quantile of this loss distribution, and expected shortfall is the average of the quantile, the average above this quantile level. So that's also why expected shortfall is called something like tail var or C var or A var in different books. You will see different names. Or sometimes you also see the name tail expectation, conditional tail expectation. That's also used in different fields. But they all basically more or less mean the same thing, which is this average of quantile above P level. The reason why we use expected shortfall as the name is because this name is chosen by the Basel Committee on Banking Supervision as their official way to describe this risk matter. So the Basel Committee on Banking Supervision, which is what I'm quoting from here, they publish a sequence of a lot of different type of articles, and one of the sequence of articles is about this fundamental review of the trading book, so this FRTB. There are a lot of articles about it. It's not only say this year or the one that I'm citing from 2016. There's actually a lot more. So one of the fundamental review of the trading book would describe how one should regulate financial institutions, especially banks, on their on all aspects of risk management. But in particular, one of the more relevant for us is the market risk. So you have portfolio of assets, securities, derivatives, all kinds of things, and you want to measure the loss or random loss on that security or on that portfolio, and then you want to get a number, which is the capital requirement. So this is the most concrete mathematical setup we can work with. And one of the changes that was proposed in the previous or current, I should say current fundamental review of the trading book, is that the value risk 0.99 is going to be replaced by expected shortfall 0.975. Although this has been basically discussed for about 8 years or so, because the first document on this discussion was 2012. I still remember when I was at the ETH in 2013, Paul discussed with me on this kind of documents extensively. Actually, it was him who introduced all these kind of regulatory documents to me, and that has been very, very influential on me. So one of the changes is this from value risk to expected shortfall 0.99 to 0.975 here. And this, of course, has been a result of a lot of discussions on value risk has been there for 20-something years. It's the standard, at least 20, more or less. Till now, it's already 26. It was introduced in around 94. So it has been a long time standard risk matter. And now the Basel Committee decided to remove it from the list of standard metric and replace it by expected shortfall. And this process is still ongoing. So this is not implemented yet worldwide. Although the regulatory document is there, but there's still most of the countries hasn't complied to it yet. But this is a quite an important transition in risk matters because these are the two most important risk matters used in practice. And the reason here they said is that the use of ES will ensure a more prudent capture of tail risk and capital adequacy. So Paul and myself, we have written quite a few papers on discussing how or why the expected shortfall would ensure a capture of tail risk. Because the regulators, they basically think about it from a more intuitive point of view. Because you define the risk matter as a tail expectation, so it should capture a tail risk. And here, actually, in all these regulatory documents, never the regulator would mention something like coherent risk matter because they wouldn't understand that very well. I think that's the main reason. If you explain to your boss, if you explain to your CEO, say that, okay, we're using this risk matter because it's a coherent risk matter, they would get lost. Well, what do we mean? I mean, this is purely mathematical. So that's why I think regulators never use the term, say, okay, expected shortfall is a coherent risk matter, so we should use that. Although in academia, of course, we usually advocate expected shortfall from the point that it's a coherent risk matter. Value risk is not expected shortfall is coherent, so we advocate that. Many peers and many academics, influential academics like Paul Armbruch, like Freddie Delban, like Alex Shade, like Hans Bohmer, they have advocated this use of coherent and convex risk matter a lot. Also, the same thing happens in insurance, which is usually called they call it TVAR mostly, used in, for instance, with solvency test. So let me focus on the banking side in this talk because the axiom I'm going to introduce is in the banking side. So the main question here is, what is so magical about expected shortfall? This question actually has been bothered, at least it has been bothering me for a long time, since the first time I visited ETH around 7 years ago. So we know that expected shortfall has many nice properties. It's a coherent risk matter, it's comontotic additive, it's a it can be written as a minimum of expected loss, so it has very nice forms. And also it's so-called tail relevant, so it measured the tail part of the distribution. That was discussed in one of my recent papers. But the problem is not these properties would characterize expected shortfall. That means there are many other risk matters. Actually, there's quite a big non-parametric family of risk matters that all satisfy these conditions. For instance, again, one example is the Gini shortfall we proposed a few years ago, but there's many more. So basically, these properties are nice. They're good. They should have them, these properties, more or less, depending on your perspective, of course. But even if you want all of these properties, you don't necessarily use expected shortfall. There's more risk matters that you can use. So the real question comes here is that why do I choose this one? Is this expected shortfall has something like very, very special that other risk matter doesn't have, so I have to go for it? Or it's just because, okay, simple is the first thing Freddie Delban came out of his mind, wrote in the paper, then let's use it. Is it that way or the other way around? So my personal feeling is that it should be the other way around. It should be that there's something magic about the expected shortfall. There's no other risk matter that share the same property, and that's why we should use it. So that's my personal feeling. But I was not able to pin down this property for a few years, but it has been in my mind for many, many years. So this problem, at least I've been thinking about it for about 5 years. And fortunately, last year we were able to solve this, come up with the axiom that I'll explain in the next 10 minutes or so. So for those of you who are not familiar with the axiomatic characterization framework, this is actually a quite big field in macroeconomics about this axiomatic characterization. And I'm citing just one very recent paper by quite a few famous economists published last year in the Theory and Decision. These are quite famous and quite important economists working on the axiomatic theory of economics. And they were basically explaining why we should be interested in axiomatic work, because there's always a lot of empirical economics economists who are arguing that, okay, the most important thing is the empirical work. We should understand data. We should try to identify economic trends. We should understand survey data or real data or any other economic data. This paper basically explains why the axiomatic framework is meaningful and useful for economic study. But for us, it seems to be more obvious, right? Because now we have to propose something like a risk matter for a regulator. And of course, the axioms, which this risk matter has satisfied, is very important. This doesn't even need a justification. But I still want to mention a big difference between the economic decision theory and risk management. The economic decision theory, usually when people try to axiomatize some functionals, risk functionals like preferences, the most famous one, of course, is utility theory, but also there's a dual utility theory, and also there's a cumulative perspective theory, there's also rank dependent utility theory, there's a lot of other theories as well. So in that theory, the most important thing is to fit people. So you have people's preferences, you get the preference, elicit the preference from some data, some survey or some other type of data, and then you see, okay, what best describe people? So you see the reaction from people coming out of data, and then you try to see, okay, what is the best theory to describe something that fits that? But in finance, it's different, because the risk matters are used by financial institutions. It's supposedly set by the regulators. But you cannot engineer or elicit the ways that the banks run their business, because if you elicit the way that they use risk matters, then what you get is you will get a institution dominant regulation. So that you're a regulator, but you listen to the bank. The bank say, hey, I want to regulate with this, and then you have to use that. This is not the right logic. The right logic for us is the regulator designs the risk matter to impose on the financial institutions, even if the financial institutions don't like to act that way. So that's very different, because now you cannot use the survey from financial institutions to tell the regulator, hey, what is the best to use? Because they will choose something that is for their benefit, but the regulator is always side on the other side. They want to protect the shareholders. They want to protect the society as well. So that's very different from a financial institution, and that's more clear from the insurance point of view, because the regulator wants to ensure an insurance company be able to pay to their policyholders. Right, this is the most important thing. That if someone go for insurance, purchase an insurance contract, you don't want that person to end up getting, oh, the insurance company couldn't pay, right? But that kind of thing is out of the consideration from the insurance company. If the insurance company is really already in default, then there's no point that they consider whether they can pay you or not. So that's a very different two sides of liability, and also from the profit point of view. So these are two different sides of the equation. So here, what I'm describing is that in financial risk management, the axiomatic approach would be different in terms of its fundamentals from the economic theory. So this is a pie chart I draw from about this expected shortfall, the most important risk matters now in finance. So around 2000 or 1999, the risk matter is introduced by Freddie and co-authors. And the theory and models, parametric estimation, all that kind of things were developed around the 20s, the 2000. And optimization is developed around the same time by Rockefeller, USF, and co-authors, and also Georg Pflug. And backtesting has been brought up around 2010 or 2011, 12 by Tillman Knighton and other co-authors in both academia and also in the industry. Because in the industry, backtesting has been a huge problem for expected shortfall. Everybody knows that eventually expected shortfall will replace value risk, but then backtesting expected shortfall has been hard. So there's a lot of studies by also Johanna Ziegel and a lot of other co-authors on this topic. The industry implementation started around 2019, but then it will go to at least 2022, but could be even further for different countries. And then all these pieces are there. But the only missing piece is the piece I'm going to talk about today, which is this axiomatic foundation. So what is the reason to use expected shortfall? All the others are how to use it, right? What are the practicalities of using it? how to push it in the industry, but we haven't explained the very fundamental reason of why is this one, not the other one, which is also coherent, right? So this will be this paper that I'm going to talk about today. And by the way, the value risk as a quantile has been characterized by quite a few papers. For instance, I listed 4, I think, major papers on this topic. If you're interested, you can look at that. The value risk basically, because it's a quantile, it is much nicer in terms of its form. So actually, there are multiple ways. All of them are non-equivalent ways to characterize a value risk. So you'll give me some axioms or properties, if you like, and then you can characterize the functional as a value risk. So here is a small list of literature on decision theory and banking and finance in terms of characterizing functionals. And as I mentioned before, the very important paper in our field, which is the most cited paper for sure in mathematical finance, cited almost 10,000 times. This one, even Paul's paper are not cited that much. I mean, of course, Paul's paper cited many times, but not 10,000 times as far as I know. In a single paper, I mean a single paper. But you probably know very well about this kind of literature, so I will just not mention too much about literature, and I will jump into the axioms. So as we said before, the functional rho is the amount of capital for a particular risk model X. And here we're looking at this one period model. Okay, this is the simplest you could imagine. And this is also the most standard one to work on. Of course, you can generalize this rate matter to dynamic framework, and then you lose a lot of nice properties, as we know. And this has been done by Walter Schachelmeier and co-authors, Michelle Cooper, and a lot of other influential people in our field. So the two very standard properties are monotonicity, which I will use, which means that if x is smaller than y, then rho x smaller than y. Okay, every risk matter basically satisfies this. The other one is low invariance. Low invariance is that the risk value will depend on the loss distribution. And this is, of course, a simplification of the whole field of risk matters. But we feel that this is reasonable because I draw this graph, and you can see that people may argue that, okay, from portfolio loss to capital requirement, this is a long process, right? In this long process, it's not necessarily low invariant because there's many things you have to consider. For instance, in finance, we all know that there's a pricing problem, right? So for risk, you have to think about its price as well. And the price is priced under the risk neutral matter. And then the low invariance is under physical matter. So there will be some kind of information that you have to take into. But that wouldn't be a problem for us because we are go from portfolio losses. We're going from here. Using some math, we write it as a model for risk factors. This standard in quantitative risk management. If you're interested, you can read Paul's book with Alex McNeil and Rudiger Frey, which describe this approach very nicely. I teach this every year. And then these risk factors will be coming up into some models. And usually you have more than one models because usually you will have, say, some uncertainty in your model. You have a parameter confidence interval and things like that. You don't want to just pin down one model. You want to pin down a lot of models. And then all these models will come to risk evaluations. So you summarize these models into several risk evaluations, and then you use some kind of adjustments. For instance, you take a worst case approach, back-tested or calibrated to some kind of worst case year. Usually you're calibrating to the financial crisis year data. And then you adjust for correlation, liquidity, and other things. You get this, the adjusted risk evaluations, and eventually you do a final layer of summarizing. I wrote magic here, but it's not really magic. It's really just a complicated way of wrapping up things. And eventually you will come up with capital requirement. So definitely this whole process is not low invariant because there's too many things you have to consider, especially scenario adjustments is definitely not low invariant. And all this data analysis from getting, say, uncertain models, model with uncertainties, this is definitely not low invariant. But there's one procedure which is low invariant, is this one. So after you get the model, let's say now you know for sure that this single model is what? Because, for instance, you say, okay, there's a joint elliptical model for my losses. Okay, this is one model. I don't know whether it's correct, but this is one model. And from this model, I need to come up with a risk evaluation. That process is low invariant. Okay, this is the risk matter part I'm going to explain. Actually, in the practice of the fundamental review of trading book, this is exactly what they do. So they have the model, and then they get the expected shortfall here, but then they have to adjust it according to many different models, and then come up with the grand solution of the what they call internal measure of capital charge, internal measurement of capital charge. So that's something they have to do. So what I'm interested in is this step. This step is actually the most important step for risk matters. All the other steps are important, but this one is really relevant for risk matters. And this step is low invariant. That's the step I'm talking about. So I'm not talking about the grand level of huge problem that you start from portfolio, think about how to invest in these stocks and dynamically trade. And on the other hand, you have the capital requirement that is output. And that's a very complicated whole procedure. You cannot really regard that as low invariant. Actually, that whole procedure may not satisfy any nice properties because it's too complicated. There's so many adjustments. But this single step where expected shortfall or value risk is really used, that is the low invariant and nice step. Okay, and the third property or axiom is also very easy to justify. This is the prudence axiom. The prudence axiom says that the risk value is not underestimated by approximations. That is, the limit of a risk measure applied to some approximating sequence. This is an approximating sequence of x. X is the true loss. It should be not smaller than rho of x. That means if you are able to approximate x in a sufficiently well way, so that means this Cassie convert to x. Here I'm using pointwise converge, but you can use different ones. You can use almost short convergence, you can use probability convergence, you can use distribution convergence, and all these are equivalent because of low invariance. All right, but let's not worry about it for now. Just think about the pointwise convergence. So that means Cassie is very close to x. And if Cassie is really close to x enough, then we should have a risk value here. This is the one actually you really use because you will never be able to capture the true risk eventually. You will always use approximations. Okay, this is the whole basic idea of statistical modeling. You will use some approximations to approximate the true. So you don't want your approximation to be systemically lower than the true. If you're no matter if this is less sign, so if this is less sign, then that means no matter how good you approximate, you always have possibilities to underestimate, no matter how good. And that's not good. All right, always have the chance to underestimate, and we don't want that to happen. Okay, this is also quite intuitive, and this shouldn't be confused with Fadou property. Fadou property is also a lower semi-continuity, similar to this type, but Fadou property, the convergence is different. The convergence is with respect to a dual norm, so that's very different from this one. So here we're completely coming from a statistical consideration, not from the functional itself, but from a statistical point of view. All right? This is the third axiom that we're interested in, and there's a proposition saying that both R and ES satisfy these three axioms: M, monotonicity, low invariance, and prudence. So these three are more or less fine for us. Although this prudence is quite intuitive, but actually it wasn't introduced in the literature. Although this is just a lower continuities, lower semi-continuity, so it's not like anything innovative. It's not anything strange. I'm formulating this with respect to the point convergence only because I want the axiom to look weak. Because in axiomatic characterization work, the weaker the axioms, the stronger your mathematical result is. That's why we want to put it as weak as possible. That's why I use a very strong type of convergence, which means that the axiom will be a bit weaker. Okay, that's a reason why I didn't formulate it using convergence in law, because convergence in law would be a weaker type of convergence, which means that the continuity will be stronger. I don't want to impose that stronger continuity, but it will eventually they'll be equivalent, of course, with the other axioms. So now the fourth one would be the most important one, and this is actually the main point of the talk, and this is actually something that I will be happy to, if I can explain this well, then basically the whole talk is more or less done. After that will be technicalities. So we read the fundamental review of the trading book actually quite a few times in different years, in different versions. So we summarize some of the concerns from the regulators. They talk about diversification a lot. You don't need to read this, doesn't matter. But you can just see that diversification is very important in the regulators' consideration. Because the regulator thinks that, okay, it's important that financial institutions don't do something very dangerous, betting on something would happen, right? The most notorious example would be during the financial crisis. Before it, many big banks put a lot of money betting on these AAA CDOs wouldn't fall in their prices. And that's not good, because you're not diversified at all. Actually, everybody is holding the same thing, more or less. And when the financial crisis hit, in UK, in Switzerland, in US, of course, the worst in US, it's a big risk, big loss for everybody. And that's not something that the regulator wants to see. The regulator wants you to really have some kind of diversification. So these are the ideas. For instance, they talk about concentration risks for undiversified portfolio. They talk about diversification effect, benefits, and they specify, okay, in which cases you should not have diversification benefit. You cannot justify that your portfolio is diversified. You cannot really claim that you have diversification benefit. Of course, we haven't mathematically say what is diversification benefit, which I'll do in the next minute. But just for the moment, let us just agree on that the regulator care about diversification very much. Another thing that regulator care about is this extraordinary losses with low probability. Now that reflects the consideration of tail risk. Okay, so that means, okay, your portfolio may be overall reasonably good, especially in the good years, it may be reasonably good. But in the bad years, or if there's a crisis hit in like COVID, then you might suffer huge loss, and that's something that regulators really feel uneasy about, because that's when you really need to be solvent. That's when the financial system is the most vulnerable. If they want you to be resilient in that situation. So this extraordinary losses or low probability events are very important for the regulators. So let me summarize this into mathematics. So diversification benefit means that you have a total loss of portfolio. The rule applied to the total loss of portfolio compared to the rule applied to individual portfolio, but you sum it up. And if this is a less sign, this is line sign, that means you reduce the portfolio, the capital requirement for the portfolio by diversification, by putting them together. So that's actually the same consideration in Asner Ibrahim's paper, the seminal paper in risk matters. So this is the diversification benefit. And then the regulator says the following. First, I want to reward diversification, which means that this should be a smaller sign if the portfolio is really diversified. Of course, it depends on how you model diversification, but this is the main message, the main general message. If you diversify, you should reduce the capital by a little bit. The second message would be you want to penalize concentration. That means I should have an equal sign if the portfolio is concentrated, not diversified. Of course, you have to define what is concentration, but this is the main idea, that if there's no diversification, then you have to use the sum of your individual losses. Of course, you can also argue that why don't you use the larger sign? But for our mathematical study, it doesn't matter. Even if you change it to larger or equal, it will eventually be the same thing. But if you want to be convinced that there should be an equal sign, you can think about the coherence matters. We don't impose coherence matter here, but if you think about coherence matters, then it cannot be larger, right? But we don't impose that here. The thing is, in the regulatory document, they always interpret non-diversification as just using the sum of the marginals. So there's nothing like more than the sum of marginals that the regulators wouldn't think that is reasonable. So that is this is what happens in the regulatory document, and we'll just take it from there. The third one is about this tail risk I was talking about. So tail event is an event of small probability, but most severe losses occur. So that is a third consideration. So how can I capture something that is big with small probability? But that's the most dangerous thing I worry about. So inspired by these three considerations, we define the so-called tail event. The tail event of a loss x is an event A with probability between 0 and 1, so it's not trivial. And then x of omega is larger than x of omega prime for all omega A in A and omega prime in A prime, in A complement. So that means if this is whole omega, A is the event where x takes value here, and A complement is the event where x takes value here. So there will be a 1 point that separate the value taken by x. So you can intuitively just think about A is the event where x losses more. Okay, that's the most intuitive explanation. The second one would be concentration. So how can I define concentration? Concentration means that in this definition, a concentrated portfolio would mean that the severe losses occur simultaneously. Okay, this is the intuitive understanding. So if I have a portfolio of a lot of different losses, if the big losses appear simultaneously, then this portfolio is concentrated, it's not diversified. So in the same picture, that means A means x1 is large, x2 is large, and xn is large. They're all large. All right, and this A can be a stress event specified by the regulator. For instance, the regulator may specify that what happens if next year the interest rate drops to -1%, or the regulator can also specify that what if COVID-19 lasts for 5 years, something like that, and then you worry about if that happens, what is their financial situation? All right, so the tail event A, which would operate on all of the losses, and if your losses they all get big loss in this event, then we will say that, okay, these losses are concentrated. They don't have to be common-tonic. In dependent modeling, there's another concept called common-tonic, which means that all these losses move in the same direction. So common-tonic means that if x1 goes up, x2 also goes up, and they're all common-tonic function of the same thing, we don't require that. We only require that here in x, these are the biggest values that this x takes, but they don't have to be common-tonic. For instance, when x1 is, let's say, 10, x2 maybe 20, when x1 is 30, maybe x2 is 10, it doesn't matter. As long as they're larger than the complement, then you're fine, all right? So they're larger than their values taken on their complement, then you're fine. You don't have to go for common-tonicity, okay? There's no common-tonicity on the event A. Okay, so this is the third step, and then we can define our axiom. This is the key axiom in this work. The most innovative new stuff is that we assume we claim that there exists an event A such that the rho of x plus y is equal to rho x plus rho y. So there's no diversification on this event if this event A is a tail event of both x and y. So that reflects the previous consideration. If you have two losses, both of them have the biggest loss at the same time, right? Then this is not diversified, and then you should not receive any diversification effect. So that is the no reward for concentration. Of course, you can formulate it for n losses, like this one, for n if they are sharing a tail event. But of course, that will be stronger, and we don't want to have stronger ones. But we can show that they're equivalent eventually. And also the axioms M, P, and NRC, no reward for concentration, they are model free. They don't depend on your probability matter. As long as your probability matter is absolutely continuous with each other, then you don't need to worry about the probability matter P. And that's quite important because that means you can actually discuss these axioms before even you specify a statistical model. Because usually statistical model is the last step. You need to decide actually, this is the more, say, practical way. So you need to tell me what risk matter you want to use, which is low invariant, but I haven't specified what probability matter we're talking about. We have to do the statistical modeling at the end. So the banks will do the internal model or using a standard model, and then come up with a distribution or come up with some other metrics on the losses. So it's kind of important that you don't have many axioms that depend on the P, because the more you depend on the P, the more difficult you specify risk matter, because the P will change eventually in the practice. Okay, so now we have 4 axioms. So arguably, I think these 4 axioms are all natural. I actually presented this a few times, and nobody has challenged that, no, this shouldn't be satisfied. Actually, everybody's saying, okay, yeah, this NRC should be satisfied. I mean, this is natural. That's at least. But if you have different ideas, of course, you should let me know why this shouldn't be satisfied by risk matter. So the main theorem is the following. If you have a functional that satisfies the 4 axioms, M, L, I, P, and NRC, it has to be expected shortfall for some P. And this P is actually specified as 1 minus PA in the axiom NRC. In the axiom NRC, we only need existence. There exists such an A. But actually, in this theorem, it tells us that if such A exists, that A actually has a unique probability. So you cannot have many different A's which have different probability. This A actually has to be with probably 1 minus P. But that is natural because the expected shortfall has a parameter 0.975. So that means P equal to 0.975 is the Basel Committee's choices. And that means a tail event of probability 2.5%, which is relatively reasonable. At least to me, it's reasonable. I mean, once in 50 years, 40 years. That means the regulator is concerned if something as bad as once in 40 years happens, then you should be really thinking about your diversified for that kind of event. Otherwise, I would penalize you. I would not give you any diversification benefit. It seems to be reasonable. Especially think about in the past 40 years, what we have, right? We have the financial crisis, that is about 13 years ago. We have the COVID-19, which is ongoing, right? We have the Black Monday, which is more or less 40 years ago. So we do have some kind of big losses in 40 years. They're not unreasonably large, right? We're not talking about the Second World War. We're not talking about the Great Depression, Depression. But we're talking about something more close to our recognition, all right? This P can be specified by the regulator. So we are flexible enough because we have a class, but we are not too flexible because we're not requiring anything more than expected shortfall. This is the main theorem. And the proof actually, of course, I didn't have the time to explain the whole proof, but basically proof is not difficult. Actually, this whole paper is not mathematically too complicated. The proof is basically using the RC. RC is the most important axiom. To understand this RC, you basically think about RC is a weaker form of linearity because you are asking for additivity, right? Additivity is a weaker, it's like almost the same as linearity if you have nice continuity. So you're requiring some kind of weak form of additivity on some event A, and then you try to prove that because we know that additive functionals has to be the expectation. So now you have some kind of additivity on the tail event. You're trying to prove that this has to be an risk matter which is linear on the tail event, which is expected shortfall. Expected shortfall is the tail expectation, right? So it's on the tail event it becomes linear. So that's basically the main idea. Of course, we still need to have 5 pages of proof for this, and we couldn't simplify it further. But the idea is not that difficult. If you are good in functional analysis, you should be able to prove this yourself. After, say, you have enough, of course, background in risk matters and background in functional analysis, should be able to do this yourself. It's not something that I feel brilliant to prove, but I think it is brilliant, at least, I mean, in my personal way of thinking, to have this axiom set up, because I think this axiom set up is really not easy, and it takes many years to do. And the next question is whether, because here I didn't emphasize, sorry, I used the domain L1, but generally the domain should be a general set. The next axiom, the next result says that the domain is actually natural because you cannot enlarge it. If you're below the L1, if you talk about L infinity or some L2 or other things, the characterization is fine. But if you look at something like L0 or L0.5, so something larger than L1, then there's no risk matter satisfied for, except the trivial risk matter rho is equal to 0. So that means we basically cannot think about something beyond L1. Although all these axioms, none of them talk about integrability. None of them need integrability. But you can imagine that because additivity is similar to linearity, but linearity requires integrability, right? So that is why integrability is natural here. And the last thing I mentioned here is that the 4 axioms, they are not dependent on each other. So you can, if you remove of them, you will get a different functionals. And this is quite important in axiomatic characterization because people want to know that your axioms, they're nice, but are they implying each other? Because if one of them imply each other, the others, then that means you're making redundant assumptions, right? And there's actually a very, very nice paper like early this year on econometrica by a professor that I don't know, sorry, from Freiburg. And I think it was a 3-page paper, a full paper of 3 pages, proved that one of the axiom of Savage in his early work on subjective probability. So that is Savage's work on subjective probability. Sorry, subjective probability, subjective utility theory. And that the paper this year proved that one of the axioms is actually redundant in a continuous setting.
Yeah.
That
so,
I think.
Sorry, Ruodu, to interrupt you. I don't think that I think I know this work. So it's not professor; it's a postdoc.
Oh, really? I didn't know that.
Yes, it's a postdoc in.
I didn't know that.
In Professor Eva Luter-Kobold's group. Yes.
Okay.
I
wow,
know
that's
this.
Nice.
Yeah. So I know this work. Yes. Yeah.
Yeah. I think it was quite nice to see such things.
Yeah. Yeah. So
and thank you for the characterization. I thought it was a professor. I automatically thought because it's one single author paper.
Yeah. Yes. Yeah. Yeah.
Oh, but that's nice to know. It's a postdoc. Wow, that's really nice. Yeah. Yeah. So what I'm saying here is not about that work, but it's about that getting rid of dependent axioms is quite important because people want to be as weak as possible. Your formulation. You add more conditions, it's more. It will be weaker. The result will be weaker. And thanks for the correction. That's very nice. So I still have about like 10 something minutes. So let me quickly go through some mathematics. So what are the mathematical tools we use here? Of course, one of the tools we have developed is this tail event. And we can say that a random vector is constrained if these random vectors share same tail event. So they are both large. They're all large in the same event. And then this mathematical structure is actually quite nice to study. It actually has quite a few nice properties which we used in our proofs. And I briefly explain them. For instance, the tail event always exists. It's unique if x is continuously distributed. When x is continuously distributed, this x would be the var of x, and the tail event would be something like this. So x larger than the quantile. And of course, this event is invariant under strictly increasing marginal transforms, because if x is large, of course x plus 1 is large. Of course, 2 times x is large, and things like that. And this p concentration can be seen as a dependence concept because it describes how the risks are dependent. So it's a notion of positive dependence. And we can show that the random vector is concentrated for all p if and only if it's common tonic. So this p concentration is truly weaker than common tonicity, but it's closely related to p common tonicity. All right, and this is not hard to see. So if for any probability level, x and y have to be large at the same time, then eventually they have to be aligned perfectly, which means if x increases, y will increase. Okay, so that is almost a trivial observation, but of course have to be formally proved. But then that means our axiom in RC is actually stronger than common tonic additivity, because the condition we use, p concentration, is weaker than common tonicity. So the additivity becomes stronger than common tonic additivity. All right. So our axiom actually implies the additivity under common tonic risks, and that's why we can have the ES characterization. Because the ES characterization really depends on this property. This property is quite important. This is actually much, I would say, the most strong. The strongest axioms in this formulation, and actually it's really quite strong. I don't want to, although I try to make it as weak as possible, but I have to admit it's a strong condition. If you don't have strong condition, you wouldn't get one family of risk matter. And if you have a p concentration, then of course you have each pair is p concentrated. But this is actually not true if the other way around. If you have each pair, you have a random vector, each pair is concentrated. It doesn't mean that the entire thing is concentrated. And there's a counterexample, but you can also build it yourself. It's not hard to build. But this is quite interesting because for common tonicity, this is different. Common tonicity, if you have pairwise common tonicity, you actually have the joint common tonicity as well. But for concentration, this is not true. So concentration is truly weaker in many ways than common tonicity. And there's a characterization of concentration. Concentration can be characterized. The most interesting part is the third part, this one. Although the concentration property cannot be characterized by pairwise concentration, but it can be characterized by the concentration between x and the rest of it. So this S is the sum of all the components of the random vector, And if xi and the rest of them, they're p concentrated, then the whole thing is p concentrated. So this is similar to common tonicity. Common tonicity, there's a famous characterization by Dannenberg, which means that if x and y are common tonic, equivalently, if you have a random vector that is common tonic, equivalently would be each of them is common tonic with respect to the rest of it. Right? So this is the same as what if you will get in common tonicity. And also the concentration can be characterized by a copula. So here I say a copula because we don't really require continuous margins. So copulas may be not unique. So a copula satisfies this this property. At the point p is equal to p. Okay, so that's some of the mathematical properties. So for financial data, this p concentration, although it's weaker than common tonicity, but it's still not common, right? Which is fine. Common tonicity is even stronger, so it's even less common. So that's fine. So the fundamentals review of the trading book specifies expected shortfall estimates based on conservative day losses of a whole year, which is about 250 trading data of an entire year. And if you choose 2.5 expected shortfall, that will be about 6 worst days of a year, right? So 2.5 times 250, around 6.20 something. So we will look at 1 year data, look at the 2.5 most large losses, and we also look back to at least 2007 because that's required by the fundamental review of the trading book. So can we find such data? Can we find data in financial losses which are satisfying this p concentration? Actually, we can, but it has to be quite strong correlated. Remember, this p concentration is a weaker notion of common tonicity, right? Common tonicity is very strong. You don't really see that in financial data. But you are weaker than that, so you might be able to see, but you have to have strong correlation. And this is the data we just got from S&P 500 in the year 2009, okay, 2009. And you see that the 3 indices, Nasdaq, S&P, and Dow Jones, they all have the biggest losses, 6 biggest losses in the same area. Actually, they are perfectly p concentrated. Of course, these are three indices. They should be highly correlated, right? You can see that the correlation is quite high. Of course, you have to find examples like these, but this is not a problem for us because we are arguing that S&P, Nasdaq, these are indices. If I treat them as an asset, if I invest in S&P index, itself is diversified. I don't care about that. I care about should I receive further diversification from investing in S&P and Nasdaq at the same time? And you probably say no, because these two are basically more or less the same thing, right? If you invest in both of them, you basically shouldn't get any further diversification. If you invest in a huge portfolio that make up S&P, of course you get diversification benefit for that because these assets are diversifying. But if you have S&P and Nasdaq at the same time and say, hey, can I receive further diversification for these two? Then you don't. I think that everybody would agree with that. And this is exactly our theory. So because these move, they don't move perfectly, but they move in the peak, they are peak concentrated. So we shouldn't get further diversification from investing in these three indices. So that means if you invest in one index, it should be the same if you invest in three in terms of diversification. There's no point of saying, okay, I get more diversification if I invest in both S&P and Nasdaq. It doesn't make sense that way. So that is to support our theory. And also we did the data for this year, and you can see that this year was even more extreme. The three indices are aligned almost linearly this year. But that's also because in this year we experienced very big losses, especially March and April in the US financial market. And that, of course, is because of the COVID-19, and there's nothing strange about it. When the COVID hits, all these indices behave like this. And actually, they don't behave like this in other years. We tried all the years in the past 20 years, and only these two, of course, this is from mid last year to mid this year, so it's not really a calendar year, but still 1 year of data. And not always you find these kind of things. Usually you find something like, out of the 6 large losses, 3 of them are the same or 4 of them are the same, overlapping from each of the indices, but they don't always align so well with each other. So it seems that when the financial crisis hits, because both of these are the two periods are financial crisis periods, you will get the large losses in the same at the same time for different indices. Of course, that has been explained very, very extensively by the econometric literature, where we know the large losses tend to appear together, and large gains not necessarily, but large losses tend to always appear simultaneously for different assets. That has been studied very well. So here I'm not trying to explain this from econometric point of view. I'm trying to explain that our theory can be realized in data, and if you agree that with this kind of data, I shouldn't receive any diversification benefit, then we're good. Okay, I will try to finish around in the next few minutes so that I get a few minutes for questions. So I will go through this very quickly about risk aggregation. So basically, one of the most important tools we use is this ES aggregation. So that is given random variable xi with some distributions, and you look at the maximum expected shortfall of all the other xi prime, which has the same distribution as xi, but the dependent structure is arbitrary. And we know that ES will be maximized by commutativity, right? That's what we know. But the question is commutativity a necessary condition for this equivalence to hold, right? That actually is not necessary, because P concentration actually would be able to give us additivity. So we are able to show that the random vector is P concentrated is equivalent to that this maximizes the ES aggregation. And of course, the aggregation is the sum of marginal ES, because ES is commutative additive and coherent. So this is a characterization of the P concentration as well. So that's actually give you a very, very strong connection between P concentration and expected shortfall aggregation. Although this is simple, this was not seen in the literature. In the literature, people always say that, okay, ES would be the biggest aggregation would happen in commutativity. But actually, commutativity is too strong. Actually, P concentration is enough, right? So this commutativity is not necessary, and we can prove that ES is additive for and only for P concentrated portfolio. So that's actually stronger than our characterization, because our characterization say that ES is additive for P concentrated portfolio, but actually this is if and only if condition. So this is the characterization of all the portfolios such that ES become additive. The proof I will just skip. It's not hard. You use a simple lemma using just this dual representation of ES and use a simple lemma. We will be able to prove this. And var, on the other hand, the var will satisfy inequalities. The var is not p-additive. That's why var doesn't satisfy the NRC axiom, but it will give you inequalities. If you use the left var, this is the right var, this is the right quantile. If you use the left quantile, with the plus is the right, without plus is the left, this is left, you will get a smaller equal sign, and with the plus, you will get larger equal sign. Okay, so var is either subadditive or superadditive for p-additive concentration, for p-concentration, p-concentrated portfolio, depending on you're using left or right quantile. So I'll skip the example. So basically, we were able to pin down 4 axioms that uniquely characterize expected shortfall, and we got some interesting math, but most interesting for people in risk management. For stochastic finance, especially people who work with dynamic framework, this may not be as interesting, but this is I think interesting for at least people in risk management, in risk matters, in actuarial science. We're very interested in such properties like homogeneity, like dependent structures, all that kind of things. Maybe I'll spend 1 minute to explain that we were developing this idea for insurance regulation. I'm sorry, I didn't have the time, insurance design. So I didn't have the time to explain this, but basically the whole idea is that the portfolio interpretation is lost in insurance, because I'm also interested in insurance mathematics, and insurance, you don't really have this kind of measures for financial risk, because financial people do that, right? But now but there's a lot of work on insurance that use expected shortfall for optimal insurance design and all other kind of optimization. The question would be, because the NRC is lost, is ES still some kind of interesting or important for insurance, or is completely ad hoc? So any other risk matter will do the same thing. Then we come up with this kind of result, which is nice. Sorry, I will have to skip all of these things. But basically, we get this rough result that if you have an overseer for insurance who oversees both insured and the insurer's well-being, and the overseer has a condition which gives both the insurer and the insured are fine, are doing well. This condition holds if and only if for some set of insurance design, these sites, sorry, I didn't explain what they are, but they are just contracts, functions. If the contract is the function is very big, then you get if and only for the mean. If the contract is reasonable, then you get expected shortfall. If contract is smaller, you get distortion. That's what we get, which is quite interesting, because now we can actually say that for very natural settings in insurance, expected shortfall is also special. But this is not for regulated capital. This reaction is not to calculate regulated capital for a completely different purpose. Okay, so I didn't have time to explain this, but don't worry about it. I will just finish here. Thank you for your kind attention. This is joint work with mostly with Ricardo Zidikis from Western, and we're developing the insurance framework with my student Ruodu Wang at Waterloo. And there's a working paper series here. If you're interested, you can look on my website, and there's quite a few papers on risk matters that we developed over the years, and I have a brief explanation of how they're connected and so on and so forth. So if you have a student who wants to do research on axiomatic theory for risk matters, and I would strongly suggest you to look at my working paper series. Thank you very much.
Okay, great. Thank you so much, Ruodu. Yes, it's a very interesting talk. Yeah. So, are there any questions? Yeah, Paul, please.
Yes. Well, thanks very much, Ruodu. Listening to your talk, I suddenly thought of some older papers by Christian Gourriérou. He wrote a lot on concentration, risk concentration, and granularity theory. Do you know of that work, and is there any relationship there?
Actually, I don't know of that work. It'd be nice if you send me some links.
Oh yeah, he wrote massive papers on that several years ago. And then also, well, I will send you a link to that. And also, if you look at that theorem you mentioned on page 20, is that like the theorem, the lemma or whatever in functional analysis, that there is no real coherent risk measure on the space of LQ as soon as you have some weak continuity property? I remember that kind of result in functional analysis. Also, Freddie has a paper.
Yes, definitely. We cited Freddie's paper on that. Yes, definitely. Actually, one of the referees brought this up to us. Yes, so definitely related, but they don't imply each other, because
no. We don't have it reminds me immediately of that result, which I know from Rudin's book or from whatever. Yeah.
Yes, but the basic idea is similar. You have some sort of linearity which forbid you to have a real valued function unless it's 0.
Yeah, and it's essentially for q less than 1. Yeah, okay, thank you. But I'll send you the reference to Goodyear.